So if you've been paying attention to the headlines this week, they've included words like Faceplant and Metaflop. Following Facebook are now Meta's disappointing earnings and new users numbers. Things weren't as good as people had hoped. So as interesting as the metaverse may be, it turns out investors still want real world results when it comes to their stock market investments. I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group. And this is our regular financial perspectives and where we talk about what's been going on in markets and the economy and things we think might be important and interesting for investors to know. Let's take a look a little bit about interest rates because they've been in the news quite a bit here this year so far. This chart just shows rates of interest for different measures of interest rates in the economy. So the 10-year treasury rate, the 30-year mortgage, the corporate BBB bond rating. And what you can see is in the last few months, those rates have begun to drift higher. The pink line there at the top is the US prime rate, which has stayed very, very steady. And the reason for that prime rate staying so steady is it's tied directly to the federal funds rate. People are anticipating the Federal Reserve will be raising interest rates soon, but they haven't actually raised rates at all yet. These other rates are going up in anticipation of what the Fed will likely do maybe in March or April. Matter of fact, those rates have gone up quite a bit. If we looked at the previous chart, it didn't look like they'd moved that much, but if you look at their relative movement, those increases in rates as a percentage of the rate have gone up quite a bit. U.S. employment numbers have continued to look pretty good. This past week, we saw 467,000 new jobs created on payrolls in January 2020. Those are good news. You can see kind of the stair step up as the economy continues to recover and to add jobs. Probably one of the better pieces of news this week is that even though the unemployment rate ticked up from 3.9 to 4.0, the reason it moved up was because more people were coming back into the workforce. The labor force participation rate, which has been stubbornly lower, has been starting to rise, and that's good news for the economy. On the right, you see that the Omicron virus has continued to kind of play a little bit of havoc with the marketplace or the workplace as people have had to miss days because of being sick themselves. You can see that number in January is 3.6 million Americans had to miss the job or miss some time at work simply because they were ill with that Omicron virus. Markets the last 2 weeks have had a little bit of a recovery. You can see here things are looking a little bit better than they were maybe after the first couple of weeks of the year. But if you're paying attention at all again to that meta idea, they have caught a lot of people's attention because while markets in the last 2 weeks have looked okay, Facebook or Meta really had a tough time when they announced their earnings last week, dropping over 23% in the last 2 weeks. But at one point, they were down 25%. It was the largest single day loss in terms of dollars by a stock in US history. So at one point, Meta Platforms had lost $252 billion of value based on that missed earnings and missed subscriber numbers. Mark Zuckerberg lost $31 billion alone in that day. That had to hurt. I think he's doing all right. But why would Facebook fall so far, so fast? Well, one of the reasons is because in the world of stock market or stock market investing, some stocks are called growth stocks, other stocks are called value stocks. Oftentimes with growth stocks, people are paying a premium in price. In other words, they're saying, I'm willing to pay more for $1 of Meta Platform or Tesla's earnings or their book value, because I think the story for that stock in the future is really good. And if something happens to kind of knock that story back a little bit, dollars can leave that company, people lose confidence in it, and they come off that high perch of valuation. What do growth and value stocks look like? This is just a chart of maybe some well-known names. And what I've done here is I've compared valuation measures of these stocks to the market average. So the market average is the Russell 1000, and you can see the price earnings ratio on average for the Russell 1000 is 22.1. The price to book ratio, 4.8. What that means is that investors are willing to pay $22 for every dollar of earnings for the market average, or almost $5 for every dollar of book value on average. Now, if you look at Meta, you can see their numbers are now more in line with the market, kind of coming off their highs. But take a look at Tesla there. That is a genuine growth stock, meaning people are willing to pay more for $1 of earnings. People are paying $303 per dollar of earnings for Tesla. They're paying $34 or better than $34 per dollar of book value for Tesla. Now look right next door at GM. GM's a classic value company. GM produces more cars and has more revenue than Tesla. And yet, if you look at what people are willing to pay for $1 of earnings or $1 of book value, it is significantly less. So why is that? Well, Tesla has a great story. People like the story that Elon Musk is telling about what Tesla means, not only for the future of cars, but for the future of technology and for the future of batteries. Elon has told a great story, and people are paying up by paying more for that book value and earnings. Vanguard did a study, and they were kind of curious about the same thing. I think after they looked back, they make kind of forecasts every year, and they look forward 10 years and say, what do they think the stock market's going to do over a 10-year period? Recently, they looked back at their forecast from 2011. In 2011, they predicted that the stock market would do 7.4% on average over the next 10 years. What actually happened was, over that 10-year period from 2011 through the end of 2021, the stock market was up 16.8% on average per year. When they look back and try to explain or try to understand how they missed by so much, they found that their predictions on earnings growth and dividends and inflation were pretty close. But the thing that they couldn't predict was investor behavior. And I think what they're saying there is they couldn't predict how much investors would respond to good stories in the marketplace and the ability of investors to pay more for those same dollar values of earnings, those same dollar values of book value over time, which caused stock prices to increase far more than Vanguard originally predicted. I like the humility of their footnote when it says, we classify this deviation, that is the deviation between what they forecast and what actually happened. They call it behavioral because it's unexplained by long-term fundamental drivers of valuation. That means their metrics, the things that they can quantify, those things that they tried to quantify couldn't explain the change. But when they looked at behavior, that's the one thing you can't quantify. What are people going to do? At the end of 2021, we published this chart in our newsletter to investors. And what we do here is we just give a variety of metrics, kind of past returns of different kinds of stocks, as well as a couple valuation metrics you can see on the right-hand side. And here, I'm just drawing your attention to the difference in price to book and price to earnings between large growth companies, which at the end of the year, you can see 14.3 and 30.6 in terms of their price to book and price to earnings. And then US large value companies at 2.7 and 16.9. All I'm showing there is that, hey, you know what? People are willing to pay more for a growth stock in terms of their price to book and price to earnings than they are for a value stock. And the question people have to ask is that always going to be the case? Will investors always be willing to pay more for growth and value? Or could there be a cycle happen when maybe value would see their kind of metrics increase and growth would see their metrics decrease? So let's look at the history of value and growth stocks in terms of their stock market returns. If we go back to 1979 and we look at the Russell 1000 growth and the Russell 1000 value, which are kind of accepted metrics for US large companies for value and growth, what you can see is from 1979 to 1999, growth stocks won. They outperformed the value counterparts. If we jump ahead from 2000 to 2011, we can see that value stocks won big over that time period because we were coming out of the tech boom, the dot-com bubble burst, and those value stocks that hadn't had great stories all of a sudden looked a little more valuable than the companies that people had been paying a lot of money for, but those earnings went away rather quickly. Then starting in 2012 to 22, growth began to be the winner again, particularly in the last 5 years. The FANG stocks, Tesla, Apple, Microsoft, they got a lot of attention. They had very good financial results, but investors continued to be willing to pay more, bidding up those price to earnings and price to book ratios, driving the price of the shares higher, which also created higher total returns for investors who own those companies. So here's the question people have to ask is, do I think that's always going to be the case, or will there be more periodic rotations? And is there any way to know when those rotations might happen? This is a chart that appeared, it was published in an article by Jason Zweig in the Wall Street Journal a few weeks ago. And what he was showing in this chart is kind of what I said, where you see for one period of time, growth did well, the next window value, the next window growth. And now we're kind of at the end of 2021 going, what's going to happen next? The point of this chart is the yellow line in the middle represents the average price to earnings ratio in the market. And you can see that it doesn't go up or down all that much relative to the other data in the chart. The thing that Zweig was drawing attention to in the chart was the top line, kind of that lightest green-blue area. And what that shows is that at different times in history, those multiples, those price earnings ratios for growth stocks really get extended. They really get much larger. You can see that happen in the 90s into 2000. So those price earnings multiples expand. People are willing to pay more for a dollar of earnings. And at some point, they get so extended that it seems like they're easily popped. And sure enough, that bubble popped in 2000, and the growth stocks kind of underperformed for the next 10 years and value outperformed. And then starting in about 2011, 2012, again, the valuations on those growth stocks start to expand because the story gets better and better and better. And lo and behold, at the end of 2021, that multiple expansion is as big as it's ever been. The difference between that PE ratio for the growthiest stocks and the average market PE ratio. So the question is, well, does that mean that we're going to have another kind of pop episode like we had in 2000? No one knows that for sure. In the last 3 months or so, value stocks have done relatively better than growth stocks, but there's no way to know whether it's going to be the same kind of situation that we had in the early 2000s. But do investors really need to make that bet? Do we really need to put all of our chips on value or all of our chips into growth and try and guess when the rotation might occur? You know, if an investor just owned value and growth over the last 30 years, this chart said they would have done just fine. Now, there are a lot of academics out there, and there's plenty of studies that show that maybe value stocks should have an advantage over the long term. You're paying less for those earnings, you're paying less for that book value, which gives you more room for those stock prices to go. But as you can see from the history of the Russell 1000 value and growth, it's not a big difference, at least in the kind of modern history that we're looking at. So as Vanguard researchers kind of confirmed, maybe it's better to not try and make the bet just on metrics, value versus growth, but to recognize that there's always going to be stories that are being told. And it's possible that a really good approach for many investors would just be to own the market as a whole instead of trying to just get one or the other and maybe outsmarting the market, which has proven very difficult to do. I like Howard Marks. He writes a memo every few months, and he's been writing it for decades. And in this memo in last January, Howard talks about how fear can drive people into bear markets and greed can drive prices into really fierce bull markets until those prices pop. But it's the last sentence here that I put on this quote that I like so much. What's clear to me, Howard says, is simply being invested is by far the most important thing. And you can see in the background that return for investors who stayed invested over the entire period looks pretty good. Maybe the thing to do as investors is to just stay invested in the market as a whole. It seems historically that that's served our purposes quite well in terms of providing outstanding growth or growth that is above the rate of inflation. You know, it's interesting to talk about value and growth stocks. There's lots of other topics out there that we could discuss. Certainly, there's lots of things in the news. And if you have any questions or any topics that you'd like to see us address, could you just kind of email them to us or contact us in some way so we could know that we can talk about things that are important to you? Also, if you'd like to get together with one of our advisors and talk about your portfolio, maybe you'd like to have a conversation about value or growth or some other aspect of investing, our advisors are ready all the time to have that conversation, look at your financial plan as well as your investment portfolio and see how you're doing, make sure everything is still suited to accomplish the goals that you have in mind. As always, thanks for watching. We hope you'll join us in a couple of weeks when we come back with another edition of Financial Perspectives. Thanks.